Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now back to the A1 Trading Show.
All right, good morning, guys. Welcome back to a Friday live stream. Hope everyone's doing well. There's my intro music for the day. Today we've got the main event. We got the main activity of the week, which is Jerome Powell speaking at 10 a.m. That is in 40 minutes from now. And markets seem to be, they're behaving like he already spoke. What we see here to start out the day, the SP500, the NASDAQ are up on the day, almost completely bouncing back. Well, not completely. Bouncing back from yesterday's sell-off towards the end of the day. But yeah, really interesting to see. We also see gold up. And I just want to show you guys this trade. Are you kidding me? Look at the entry on this. I self-proclaimed am not the greatest at entering the market at the right time. It's a really difficult thing to time the market. But can you look at that trade? Are you kidding me? This is either going to look like a heroic trade if the market, continues higher today, or it's going to look it's going to really disappoint me if it comes back and takes out that entry price. Look at how good that entry was. I wish I had more of these types of entries. My goodness. But take a look at the daily chart. I bought gold yesterday inside of the VIP room and immediate profit, which, man, can the market gods just like do what I ask them to do, please? That would just make my life easier. I bought GLD, which is the gold ETF, yesterday, and you can see like crazy how this thing whipped down to that level, and look at just how quickly it respected. This is where, I am an advocate primarily for fundamental analysis, but technicals play a role, man. Look at the entry on this guy. Just snapped right off of that beautiful level of support. Very nice. But yeah, I went long gold yesterday, and I think I'm going to go ahead and trim my stop on this one. Taking a look at the daily chart, the way we reacted off of this wick. In fact, that's what I'm going to do right now. I'm not going to move it all the way to break even, but I am just going to trim this. I don't mind if we come back and test this area. I'd be fine with that. I just don't want to see it break. So I'm going to move my stop here really quick while we're on the stream. So bear with me. So I open up my MT4. I don't trade I use a demo account on MT4 to track my trades. I actually trade stocks, primarily stock ETFs for positions. Some US traders choose to use futures for gold. I choose to use ETFs. It's just a personal preference. Anyways, I'm moving my stop loss here on gold. I basically want to put it where, if we break through this support level again, that's going to be, idea was null and void. So I'm going to go for a 24.59 stop loss. Okay, we're going to go 24.59. And now I'm just going to update my trade here inside of our VIP room. Let's go here. Man, this trade, I want it to work out because of how beautiful the entry was. Trimming my risk on this trade ahead of Powell's speech in 35 minutes. Stop tightened just below yesterday's low near my entry. Looking for Powell to signal more rate cuts. 50 basis point possibility cut in September would be very bullish for gold, in my opinion. Okay, so stops. There we go. All right. Whoops, I didn't share a screenshot with that. Let me just go ahead and share that quickly. And again, I don't actually have a take profit order on this trade. It is just I just use this to track my my risk reward for my trades. But again, gold, we are locked in on this one, man. That is a very, very clean reaction to that support level. Clearly, there was a lot of buying pressure that came in, and I'm feeling a little bit heroic with that entry. I'm not going to lie. That entry feels really nice. Balla doesn't like trading GLD. Yeah, I mean, to each their own. I trade a lot of ETFs, so I just prefer to, I trade things like semiconductors, or I trade things like SPY. Why I love ETFs way better than futures is with ETFs, I can get very specific to what I want to allocate money to. I could allocate to specific countries. I could allocate to specific sectors. I could allocate to specific bonds, which I guess you can do with futures. I can allocate to specific industries like cybersecurity or medical devices. That is why, to me, I really like trading / investing in niche ETFs. A lot of what I trade is, the NASDAQ and the S&P and gold and stuff, but I also do trade individual sectors, etc. So that's why. I also trade a little bit of options. So I love the versatility that I have trading on a stock brokerage over a futures brokerage. Great entry on gold. Congrats. Thank you. I appreciate it. We'll see if it holds. I mean, this by the end of the day could look really, not great. If gold rolls over, if Powell comes in more cautious to cut rates today, it's not going to be great for gold. So let's set this up. When we're talking about gold, we're talking about the dollar, we're talking about stocks today. Let's set this up for Powell's speech in 30 minutes. If Powell comes in, let's just map this out. Okay. So if Powell comes in and he is hawkish, he's not going to be hawkish. They're not going to look to cut rate or hike rates. It's either, let's do this. Is he going to be more in the 25 basis point kind of idea or more on the 50 basis point kind of idea? Because the implications here, guys, are huge. All technicals go out the window when these fundamentals come into play, okay? If the Fed is looking to cut interest rates quickly or slowly, it will dramatically change which areas of the market perform well or poorly. So if Powell comes in very dovish, meaning he says the revisions to the labor market data, as well as just the trends of cooling labor data and the proper inflation progress that we've made, make us feel more confident towards a 50 basis point rate cut. What will that do? A 50 basis point projected cut in September, if that becomes the new expected. Right now, this is more expected by the market. If you get 50 basis points, gold is going to fly, in my view. But what happens to stocks? Stocks, they diverge, in my view. If you get 50 basis points, most things are going to rally. They're going to say, look, great, we'll get, most things are going to rally. If you get projections for massive amounts of rate cuts, 50, 50, 50, like over every single meeting, then the market's going to get nervous. But a 50 basis point cut to start things off if they do 100 basis points by the end of the year, stock market's going to like that, because the stock market's going to say, okay, that is relieving a lot of the restrictive policy that the Fed has currently. 25 basis points, though, there's a divergence here. In this, when I just talked about sectors, right? What's going to like this one? Real estate. Real estate would like this. Small caps, right? The Russell would like that. Smaller companies would love this. This would be more relief on the interest rate front. What would care less about this? Big tech, right? I think that, Qs would still go up, but they're not going to scream higher compared to, if you told me right now, Nick, Powell's going to signal a higher probability of a 50 basis point cut in September, I would say Russell over Qs. If you told me, also gold, right? So here's the things that do well. If this happens, if you lean towards 50, TLT, so bonds, gold, real estate, small caps, that party leaves the station, right? That train leaves the station for sure. But what about if you get 25 basis points? In this case, 25 basis points, the Qs probably look the best, in my view. What else looks the best? I stay long SMH in both scenarios. I'm okay with both. That's semiconductors. Qs, will do well if the economy's hanging in there and you're getting rate cuts, regardless if it's 25 or 50, Qs are probably doing well. But if you want to talk about outperformance, if you think 50 basis points is coming in September, these are your friends. Real estate, small caps, gold, TLT, right? Bonds, if you're more cautious, if you think rate cuts are coming from the wrong reasons, these are your areas. You can see how many niches there are within this concept of rate cuts. Rate cuts is a deep conversation. Are you talking about rate cuts for, the right reasons, meaning the economy's cooling off and we have plenty of room to cut rates because inflation's coming down? Then that's sweet spot, good situation. That's where you want to be long these two. If you are getting a perfect soft landing, what do you want to be long? If you said there's going to be a soft landing for sure in the next 12 months, real estate, small cap companies, high risk stocks, tech, those things are going to be monsters. But it's a fine line. It's a fine line, guys. This is where it gets tricky. There's divergence even within the 50 basis point concept, because guess what happens? If you get 50 basis points because the Fed is really worried and that the economy is looking really rough, suddenly these are going to do horrible and these are going to shine. See how thin if you want to be outperforming the market, this is why it's hard, because the market is not, it's a winner takes all kind of market right now. Unless, it's not a winner take all, a 25 basis point cut. Because what that would signal is that the Fed is like, okay, things are good enough and we don't see the economy crashing. We think things are good. This is, by the way, this is kind of the forecast. This is what is likely going to happen, in my view, and according to the market. Some people are leaning more towards the 50. Some people think it should be 50. I think the Fed will probably do 25 because there's been some good labor data that's going with it. By the way, speaking of labor data, did anybody try out the Edge Finder this week? If you tried out the Edge Finder for the first time, can you do me a big favor and type me in the chat? I would love to just see. I think we had about 1,300 people apply for a trial of the Edge Finder during this week. If you tried it for the first time, how was it? I hope that you enjoyed it. We had a lot of fun doing that. We shared a lot of Edge Finder access for free this week. And it is over. It is shutting down. No more free Edge Finder, sorry. But if you got a chance to try it, then I want to ask a favor for you or from you. If you enjoyed the trial, if you enjoyed checking out the tool, if you liked looking at it, please do us a favor. If you'd like to purchase the tool, I'll tell you something cool in just a second. We've got discounts for you. But if you don't plan on buying it, can you please do us a big favor? Whoever you got the trial from, it's either Emily, Drew, or Hallie, our 3 support reps here at A1. If you could just do me a huge favor, please take 30 seconds to just write back to them over email, message, however you communicated with them, your feedback on how the tool was in your view. What can we improve? What did you like? What did you not like? We would really, really appreciate that if you could take some time to respond to your rep that helped you out during this trial period. Part of our goal here was to get some feedback, to get some thoughts from the community, from people who tried out the Edge Finder. So if you tried out the Edge Finder, please take a second to respond back to whoever administered your trial and let them know. Yeah. So again, the other thing I mentioned is that we are going to be doing a discount for people who tried out the Edge Finder this week. If you decided that you like it and you can't live without it, then join the party. Me too, because the Edge Finder is kind of amazing. Hold on, I'm looking for a sound. Oops, hold on. I hit the button twice. The Edge Finder is kind of the champ. If you liked using the tool and you would like to get access to it permanently, if you want to take us up on the Edge Finder for the long term, it's a one-time fee to get access to the Edge Finder. If you enjoyed your trial, we're going to be doing something cool here. We're currently doing for today 35% off. If you enjoyed using the tool and you want to keep it, it's shutting down in just a few hours. So if you missed the trial, unfortunately, that is it. But if you enjoyed your trial, if you like checking it out and you're like, this is a great tool, 35% off. Here's how we're going to do this. If you would like to get 35% off on the Edge Finder right now, we're going to drop the link here in the chat to speak with a member of our team. Again, either Drew, Emily, or Hallie, who can help you out with getting access for that 35% off discount. So there it is. Send this direct message here. If you enjoyed the trial, if you like the tool, don't miss out. That's a huge savings on the tool. We're doing that just as kind of a end of the week offer for people who tried it out this week. It was really fun. We had a lot of people trying it out, a lot of great feedback. I was reading a lot of comments from you guys, just people, excited about the tool, and that really makes our day, to be honest. It deserves the funk sound. Heck yeah, it does. I feel like it's such a rave sound. I don't know. Anyways, I also wanted to look at some stuff. I wanted to look at some stuff really quick on the Edge Finder. Gold bullish rating killed it. This pullback yesterday was really a nice pullback opportunity. Looked kind of scary there, but came down to this level and just snapped right back, which is awesome. Let's look at some other ideas that the Edge Finder has had. We talked about pound USD. Let's look at where the pound dollar is looking. Look at that pound dollar. My goodness, this thing is a beast. So the bullish rating on the Edge Finder for the pound dollar has looked good. I know Kiwi dollar, we also discussed this one. Not bad. Nice little bullish move through. What else? We can just take any of them. EuroCAD. I haven't even looked at this pair in a while. EuroCAD's been getting a bullish lean. Very nice. Pound CAD. Let's look at Pound CAD. Pound CAD has been getting a really strong reading. Let's see where this one's at. Look at that. Beautiful. Pound CAD. I don't trade this pair usually, but looks really interesting. If we pop through the highs, that could lead to some further upside. That looks strong. UJ. Let's look at UJ. UJ's been getting more of a bearish read the last few weeks, which has been really an interesting call. I never took any of those trades, but man, has it been pretty spot on to lean on the bearish side of this one. UJ really, as a potential hedge to my risk on positioning, a pop in dollar yen to me looks like an opportunity to stay bearish on it. So I'll keep an eye on this one. But the biggest one that I saw this week was the gold setup. Gold actually finally gave us a dip. I got in on that one. And again, the gold trade that I'm in, the entry was remarkable. Let's see though if there's any follow through. That's the question. The entry was really, I mean, you could not have asked for a better pullback and entry, and then the bounce was so strong. And I transparently, my entries do not look usually that good. That is just an insane reaction to this level. It just snapped off that zone of support. But my stop loss was bigger initially. I trimmed my stop loss for those just joining the stream. I trimmed my stop loss on gold, and I'll walk you through my thought process on this because this may be helpful. So the trade I shared yesterday, we can walk through just really quick the thought process on this. So I bought gold at 24.72 on the spot price. Buying gold on today's dip. Stop below structure. This is my first attempt. Willing to be wrong and buy a second time if we see a bigger pullback to this year's strong uptrend. I don't know if you guys know this, but gold is up more than the S&P 500. I think it's up like 22% for the year. It's outperforming stocks, which have had a really strong year. Just shows how strong gold is. And what is that signaling? To me, that signals that there's still some worrisome feelings in this market. There's still people who are a little bit cautious that the Fed may not pull off a soft landing, that you may get some dips in the economy, both in the US and internationally. So something to think about. Cooling economic data globally is likely to lead to continued interest rate cuts from major central banks globally. The US, UK, EU, and many others are actively looking to reduce their base rates or interest rates, which is a positive catalyst that has given strength to gold this year. Until something changes, I believe this is still a strong case for gold bulls. There's also been, I don't know if you guys have seen this, but a very consistent and strong buying of physical gold by central banks in the world. And what this signals to me, and what is kind of a little bit, if you want to be a doomsday for a person for a second, the de-dollarization component of this is a little bit worrisome. So the idea is basically central banks are buying physical gold and offloading US dollars, because maybe other central banks in the world are saying the Fed is or the US national debt is ballooning higher. There's no end in sight. And we have a lot of dollars. You know, the dollar is held by major central banks all over the world tremendously. Like huge amounts of dollars have been exported into the world. And so it's maybe people are saying, well, the US economy, the US national debt situation could sour. And so to diversify, many other central banks are going back to the only true through history store of wealth, which is gold. The only quote unquote real money of the world, if you want to get real doomer and go down this avenue, is gold. Gold's the only thing. There's no fiat currency of history that has survived forever. They all go away. As crazy as it sounds, the US dollar probably goes away at some point. There was a time where Germany, the German mark, was like the status of the dollar. There was a time where the British pound had the global reserve currency status of the dollar. It changes over time. Do I think it's changing soon? No, not particularly. But other central banks may be worried about that, and that's maybe why they're buying gold aggressively, which is the one thing that has always, for thousands of years, held its power, or held its purchasing power. But central banks are just like you and I. We don't, if you hold a bunch of cash and the value of the dollar rapidly deteriorates, you can see how that's not particularly, that's a big risk for central banks. So anyways, that's why I picked up some gold. I've been bullish on gold this year. I've missed out on this recent pop, and I I caught this move here. I have not really taken part in this move here, but I bought this pullback. We'll see how it goes. But that entry, by the way, you can find all the information on the trades that I'm taking within our Discord channel. That is available. We're doing a 35% off sale for the Edge Finder today. But if you'd like to join the VIP room and you're not in there already, you can. We'll drop a link here in the chat. You could speak with us again if you want that 35% off sale for the Edge Finder. Also, by the way, that was part of the reason the entry here happened. Gold is still very institutionally bullish. And I'll show you that in its full capacity here for a second. So if we go to sentiment, we go to COT data. The thing that you'll notice here is that gold continues to be very institutional money is still very long on gold. And this is not like speculation or like, oh, I think big money might be doing this, or trying to like watch candlesticks to try and decipher what smart money is doing. That's not this at all. Commitment of traders data. The cool thing is it is straight up reported positioning by hedge funds and banks that have to report their holdings to the CFTC, and then it gets published. And then our software goes and pulls that up and then makes a visualization tool for traders. So again, this gold weighting here still very bullish. So institutional money still very leaning on the bullish side of gold. So that was part of the reason why I bought it yesterday on the dip. Again, I just mentioned this, but if you guys would like to try out or if you'd like to get access to the Edge Finder or get access to the Discord VIP room, everything today following our free week on the Edge Finder, which is ending shortly, everything is 35% off today. So if you'd like to get access to the Edge Finder, or you'd like to get access to the Discord VIP room, send us a direct message here. We got a couple people on the line who can hook you up with the discount details and or give you any information. Also, if you've been chatting back and forth with someone from our team, Emily, Drew, or Hallie, just send them a direct message, or you can email them and just let them know that if you're interested in the 35% off discount that you saw on the live stream, we can get you set up with that for a little bit here. That is currently available. So for everybody who tried out the tool, there you go. Nick, Citibank expects $3,000 per ounce by mid-2025. That's the thing, James. I would not be surprised if that happens. $3,000 seems far away. But, at the beginning of this year, gold was right around 2,000. Think about how much we've moved. A move like this has been 20 or so percent to the upside. To get to 3,000 is another, it's an attainable number. It sounds crazy, but another 20% is possible if we're going to see the gold bull run continue next year, which I think it's more likely to continue than reverse if the Fed is really starting a rate cut cycle. I think that's a pretty appropriate idea. So anyways, we're going to take just a quick break here, guys, and we're going to be joined by Kenzo to talk a little charts here ahead of the Fed meeting. He'll be sticking around with us for a few minutes here. So stay tuned. We will be right back with Kenzo just after this. If you're someone watching the show right now and you're outside of the US looking for a better brokerage, listen up. I wanted to take a moment to mention today's live stream supporter, Vantage. Vantage allows traders outside of the United States to trade CFDs. You can trade everything from commodities like gold, you can trade US indices or global indices, and you can even trade FX all under one brokerage, and you can connect to MetaTrader 4 and trade directly on tradingview.com. Not to mention, they also have a really good sign-up bonus going on right now. So we'll drop the link to that down below in the chat as well as in the description of this live stream. Check out Vantage. Now back to the show. All right, we're back with Kenzo. Hey, Kenzo, how's it going, man?
I'm doing great, thanks, and you?
I'm doing well, and we are getting on the mic here right a few minutes before the chairman is set to speak. What's on your radar today? What are you watching here? You've got your screen shared. Maybe we can let you take over for a second.
Yes, I was actually watching gold and Nasdaq, also US oil. So yeah, on dollar index, we still see that the dollar is actually quite weak. And at the moment, since we're waiting for for Powell to speak, I think maybe he will confirm that maybe we're gonna have some rate cuts. I just and unfortunately, he might not really point out the size, whether it's gonna be 50 basis points or 25. But I'm hoping for some good news. I think obviously they will actually try to cut the rates, or maybe just to give investors a hint that they will cut the rate. So, and that I think is going to be very good for us to look for gold, Nasdaq, and the other pairs. At the moment, I feel confident that we're still going to have some very nice bullish move.
Yeah, and so when you talk about the dollar continuing to trend lower, that is kind of indicating that the expectation is that Fed is going to cut rates, whether it's 25 or 50. It's very likely that we do see the Fed begin to cut rates. In fact, at this point, it's practically a certainty. As you know, we saw in the meeting minutes yesterday, even more commentary from Fed officials that. It is. They seem to think it's appropriate to start cutting rates. And as you just mentioned, the question is now: are we going to see 50 basis point cut or 25 basis point cut? Which way do you lean? Do you think more likely to see a 25 basis point cut from the Fed, or do you think a 50 point cut is possible?
Yeah, I think both are actually possible. But I think for this year, I think we left with, if I'm not mistaken, I think we left with three FOMC events where they will be taking whether there are, I mean, those on those events, I think they will try to maybe to split that number. I don't really believe that they will go with 50 because that will show a little bit of panic. I think maybe they might split that and make it maybe 25 for three times. I also saw, I think on CNBC, someone was talking about he expect three times or three cuts this year, which means it will be maybe 25 basis points on those three events. And when we check nicely, yeah, it makes sense because it's not like everything it's maybe crashing at the moment. Already the market it's recovering very quick. But when we check the overall of the move, Nasdaq, US 30s, S&P 500, if we can check for 12 months, we are actually at the highest levels. So which means we're not really seeing anything going wrong. Plus, other events, retail sales, CPIs, PCEs, they're all going down. That is actually a good sign for them to cut the rates. But going hard, I don't think maybe that is going to help. I think already we know that they will cut the rate. So for them, I think they can just go slower to a point where maybe they will reach their target.
Kenzo, you also mentioned a second ago talking a little bit about U.S. oil, which has been really beaten down recently. I want to get your thoughts on this. We're hitting this big multi-month support level right around $73 a barrel. Do you think that oil may be bottoming out here? And I guess to tack on to that, if we are going to see some semblance of a soft landing, right, meaning that the Fed begins cutting rates and the economy hangs in there and maybe even starts to reaccelerate again, could this potentially be a great kind of value buy on oil or perhaps energy stocks? With the idea being, if the Fed cuts rates and things, start to actually perform well and the economy starts to accelerate and we see global growth bounce back, that could lead to oil demand going up. So are you more on the bearish side, thinking that the economy is going to slow further, or that supply will continue to be very high, so oil could go lower? What are your thoughts on it? Do you think it's near a low, or do you think it has room to continue going lower?
Yeah, I think we will see maybe a bounce back. I'm expecting to see the market trying to bounce back at the moment. So I think I don't know if it's last week or last week, OPEC countries actually they were meeting which means on that they were actually trying to say they will be reducing the supply of oil. And on that, the market did try to go higher. The market tried to go higher around this level, but it went down again. But what I like is the time the market was going down and to reach this level, actually that reduced, or it gives us a hope that there is a reduced uh, inflation, because we know that when oil is going up, it means that things slowly or inflation slowly has an effect. And I like the fact that everything, or every almost all the major economic events, they were like cooling off, and also oil followed that. That was actually good, but slowly I think we will see the market trying to push up again, even though maybe it might not really really that be aggressive, but I feel like the market has to go a little bit higher.
Yeah. I think, Kenzo, when it comes to oil, if you're somebody who is very bearish on oil at these levels, I think what you kind of have to think is you sort of have to think that global demand is going to continue to slow. And if that is your thought process, then you think that the global economy is likely to go into, some form of a stronger recession. So if you're somebody out there and you're like, I'm very bearish on oil, you have to remember that oil, like any other commodity, is a physical, a good that has a supply and demand attached to it. The supply and demand dynamic is impacted by the global, economy. And so the thought process is, if oil goes low, remember, there is scarcity involved here. So if the economies of the world are not falling apart, which they are not currently, there is a floor to this price of gold, of oil, right? Same thing with copper. Same thing with agricultural commodities. They have a physical demand in the world. There's a real demand for them, and that there is a floor to that. Where how low prices can go. That being said, if you get something where the global economy is expected to really shrink, then oil could go much lower. But I think you and I, Kenzo, are more on the page of, or more on the thinking of, the global economy is not falling apart. And if we do see rate cuts start coming across, the Fed and other places, it could lead to bounce back in the economies, and perhaps we look back on oil and say, wow, $73 was actually very low in the price of oil.
Mm,
Not to mention, there is that one other thing to think about, Kenzo, is Russia and Ukraine are still going at it. There's the Middle East, there's Taiwan and China. If you were to say, none of those are going to have any escalation for years to come, I would disagree with that. I think there's probably a good chance that at some
mm,
point in the next, year, 2 years, 3 years, unfortunately, there's probably going to be some supply concerns which cause oil to go up due to
yes.
conflicts.
Exactly. No, that's true. That's true. So at the moment, actually, what I like about the market at the moment is we're focusing on the good side, because it seems like inflation all over the place is going down. But we still have these tensions which can actually change things very quick, or let's say overnight, because
Yes.
if China and Taiwan on the other side do something, that is gonna be bad for the stock market also.
Yes.
And on the other side, oil, Middle East, also we have this issue of tensions nonstop, or also Russia. So that is going to affect oil like way too bad, and automatically that will also lead to higher inflations again. You see.
Yeah.
So, but at the moment, it's like the market doesn't really want to focus much on that. So I think at the moment we also, that's why I like to also check gold. So it's also good. You can see gold is still going higher to
Hmm.
show that there is still some panic here and there. Because mostly, if gold is still pushing up like that, I understand that yes, we understand we are thinking about rates cuts, but we have tensions. That's why we also see gold
Hmm.
going higher. Also, we can see that it's
Yes.
trying to reverse, but the reversal is not really that strong. So it means there are people who think maybe something might happen. That's why we still see gold trying to go even higher.
Yeah, and I think that's a really good point that you bring up with gold, Kenzo, is, you know, if we look at the year-to-date performance of the S&P 500, the Dow Jones, the Nasdaq, and we compare it to gold, gold is killing it. So, that's telling us something about the state of the market, and something to think about. Kenzo, we've got to run because we got the next, or we're going to react here. We're going to pull up the stream here in just a moment. Thank you for coming on today and sharing your thoughts. Before we let you go, guys, I'm going to drop the link here in the chat to Kenzo's YouTube channel where you can keep up to date with what he's watching, what he's looking at in the markets. Free value over there. Go subscribe to Kenzo. Got 940 people here, guys. Make sure to go show him some support on his channel. Kenzo, thank you very much for coming on the show today, man.
Thank you very much, man.
See ya. All right, guys. So we are standing by. We will have Powell on the screen in just a second. Stick around. We're going to be watching and reacting to what he has to say. Please, just a heads up, we got 940 people here. Please trade responsibly. A lot of traders are going to lose a lot of money in the next hour. So please don't be one of them. Trade small. Here comes Powell.
Thank you, Karen, and thanks to our host from the Kansas City Fed. It's great to be back here today. 4.5 years after COVID-19's arrival, the worst of the pandemic-related economic distortions
Got muted.
Are now less tight than those that prevailed before the pandemic. Supply constraints have normalized, and the balance of risks to our two mandates has changed. Our objective has been to restore price stability while maintaining a strong labor market, avoiding the sharp increases in unemployment that characterized earlier disinflationary episodes when inflation expectations were less well anchored. While the task is not complete, we have made a good deal of progress toward that outcome. Today, I will begin by addressing the current economic situation and the path ahead for monetary policy. I will then turn to a discussion of economic events since the pandemic arrived, exploring why inflation rose to levels not seen in a generation and why it has fallen so much while unemployment has remained low. So let's begin with the current situation and the near-term outlook for policy. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. The FOMC's primary focus has been on bringing down inflation, and appropriately so. Prior to this episode, most Americans alive today had not experienced the pain of high inflation for a sustained period. Inflation brought substantial hardship, especially for those least able to meet the higher costs of essentials, like food, housing, and transportation. High inflation triggered stress and a sense of unfairness that linger today. Our restrictive monetary policy helped restore balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remained well anchored. Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed. My confidence has grown that inflation is on a sustainable path back to 2%. Turning to employment.
Russell's
in the
flying.
years just prior to the pandemic, we saw the significant benefits to society that can come from a long period of strong labor market conditions. Low unemployment, high participation, historically low racial employment gaps, and with inflation low and stable, healthy real wage gains that were increasingly concentrated among those with lower incomes. Today, the labor market has cooled considerably from its formerly overheated state. The unemployment rate began to rise over a year ago and is now at 4.3%. Still low by historical standards, but almost a full percentage point above its level in early 2023. Most of that increase has come over the past 6 months. So far, rising unemployment has not been the result of elevated layoffs, as is typically the case in an economic downturn. Rather, the increase mainly reflects a substantial increase in the supply of workers and a slowdown from the previously frantic pace of hiring. Even so, the cooling in labor market conditions is unmistakable. Job gains remain solid, but have slowed this year. Job vacancies have fallen, and the ratio of vacancies to unemployment has returned to its pre-pandemic range. The hiring and quits rates are now below the levels that prevailed in 2018 and 19. Nominal wage gains have moderated, and all told, labor market
Trailing stops
conditions
on
are now
stuff
less
for
tight than just before the pandemic.
members in the Discord. I'm trailing a bunch of stops
2019,
right now.
a year when inflation ran below 2%. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions. Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement,
Super dovish.
we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions. So let's now turn to the questions of why inflation rose and why it has fallen so significantly even as unemployment has remained low. There's a growing body of research on these questions, including Gary Eggerson's work, which we'll shortly discuss. And this is a good time for this discussion. It is, of course, too soon to make definitive assessments. This period will be analyzed and debated long after we are all gone. The arrival of the COVID-19 pandemic led quickly to shutdowns in economies around the world. It was a time of radical uncertainty and severe downside risks. As so often happens in times of crisis, Americans adapted and innovated. Governments responded with extraordinary force, especially in the United States. Congress unanimously passed the CARES Act. At the Fed, we used our powers to an unprecedented extent to stabilize the financial system and help stave off an economic depression. After a historically deep but brief recession, in mid-2020, the economy began to grow again. And as the risks of a severe extended downturn receded, and as the economy reopened, we faced the risk of replaying the painfully slow recovery that followed the global financial crisis. Congress delivered substantial additional fiscal support in late 2020 and again in early 2021. Spending recovered strongly in the first half of 2021, and the ongoing pandemic shaped the pattern of the recovery. Lingering concerns over COVID weighed on spending on in-person services, but pent-up demand, stimulative policies, pandemic changes in work and leisure practices, and the additional savings associated with constrained services spending all contributed to a historic surge in consumer spending on goods. The pandemic also wreaked havoc on supply conditions. 8 million people left the workforce at its onset, and the size of the labor force was still 4 million below its pre-pandemic level in early 2021. The labor force would not return to its pre-pandemic trend until mid-2023. Supply chains were snarled by a combination of lost workers, disrupted international trade linkages, and tectonic shifts in the composition and level of demand. Clearly, this was nothing like the slow recovery after the global financial crisis. Enter inflation. After running below target through 2020, inflation spiked in March and April 2021. The initial burst of inflation was concentrated rather than broad-based, with extremely large price increases for goods in short supply, such as motor vehicles. My colleagues and I judged at the outset that these pandemic-related factors would not be persistent, and thus that the sudden rise in inflation was likely to pass through fairly quickly without the need for a monetary policy response. In short, that the inflation would be transitory. Standard thinking has long been that as long as inflation expectations remain well anchored, it can be appropriate for central banks to look through a temporary rise in inflation. The good ship transitory was a crowded one, with most mainstream analysts and advanced economy central bankers on board. I think I see some former shipmates out there today. The common expectation was that supply conditions would improve reasonably quickly, that the rapid recovery in demand would run its course, and that demand would rotate back from goods to services, bringing inflation down. For a time, the data were consistent with the transitory hypothesis. Monthly readings for core inflation declined every month from April through September 2021, although progress came slower than expected. The case began to weaken around mid-year, as was reflected in our communications. And beginning in October, the data turned hard against the transitory hypothesis. Inflation rose and broadened out from goods to services, and it became clear that high inflation was not transitory and that it would require a strong response if inflation expectations were to remain well anchored. We recognized that and pivoted beginning in November. Financial conditions began to tighten, and after phasing out our asset purchases, we lifted off in March of 2022. By early 2022, headline inflation exceeded 6% and core was above 5%. New supply shocks appeared. Russia's invasion of Ukraine led to a sharp increase in energy and commodity prices. The improvements in supply conditions and the rotation in demand from goods to services were taking much longer than expected, in part due to further COVID waves in the United States. And COVID continued to disrupt production globally, including through new and extended lockdowns in China. Higher rates of inflation were a global phenomenon, reflecting common experiences: rapid increases in the demand for goods, strained supply chains, tight labor markets, and sharp hikes in commodity prices. The global nature of inflation was unlike any period since the 1970s. Back then, high inflation became entrenched, an outcome we were utterly committed to avoiding. By mid-2022, the labor market was extremely tight, with employment increasing by 6.5 million jobs from the middle of 2021. This increase in labor demand was met in part by workers rejoining the labor force as health concerns began to fade, but labor supply remained constrained. And in the summer of 2022, labor force participation remained well below pre-pandemic levels. There were nearly twice as many job openings as unemployed persons from March 2022 through the end of the year, signaling a severe labor shortage. And inflation peaked at 7.1% in June 2022. At this podium 2 years ago, I discussed the possibility that addressing inflation could bring some pain in the form of higher unemployment and slower growth. Some argued that getting inflation under control would require a recession and a lengthy period of high unemployment. And I expressed our unconditional commitment to fully restoring price stability and to keeping at it until the job is done. The FOMC did not flinch from carrying out our responsibilities, and our actions forcefully demonstrated our commitment to restoring price stability. We raised our policy rate by 425 basis points in 2022 and another 100 basis points in 2023. And we've held our policy rate at its current restrictive level since July 2023. The summer of 2022 proved to be the peak of inflation. The 4.5 percentage point decline in inflation from its peak 2 years ago has occurred in a context of low unemployment, a welcome and historically unusual result. So, how did inflation fall without a sharp rise in unemployment above its estimated natural rate? Pandemic-related distortions to supply and demand, as well as severe shocks to energy and commodity markets, were important drivers of high inflation, and their reversal has been a key part of the story of its decline. The unwinding of these factors took much longer than expected, but ultimately played a large role in the subsequent disinflation. Our restrictive monetary policy contributed to a moderation in aggregate demand, which combined with improvements in aggregate supply to reduce inflationary pressures, while allowing growth to continue at a healthy pace. As labor demand also moderated, the historically high level of vacancies relative to unemployment has normalized primarily through a decline in vacancies, without sizable and disruptive layoffs, bringing the labor market to a state where it is no longer a source of inflationary pressures. A word on the critical importance of inflation expectations. Standard economic models have long reflected the view that inflation will return to its objective when product and labor markets are balanced, without the need for economic slack, so long as inflation expectations are anchored at our objective. That's what the model said. But the stability of longer run inflation expectations since the 2000s had not been tested by a persistent burst of high inflation. It was far from assured that the inflation anchor would hold. Concerns over de-anchoring contributed to the view that disinflation would require slack in the economy and specifically in the labor market. An important takeaway from recent experience is that anchored inflation expectations, reinforced by vigorous central bank actions, can facilitate disinflation without the need for slack. This
Hey, Chris.
attributes
What's up, man?
Much of the
How we
increase
doing?
in inflation to an extraordinary
We're
relationship
watching it.
between
It's
overdue
happening.
and temporarily distorted
I see
demand
that.
and constrained supply. While researchers differ in their approaches and to some extent in their conclusions,
Russell's up
a consensus seems to be
2.3%. My
emerging,
goodness.
which I see
I love it.
as attributing most of the rise in inflation to this collision. All told, the healing from pandemic distortions, our efforts to moderate aggregate demand, and the anchoring of expectations have worked together to put inflation on what
There was a huge jump in the
increasingly
futures market
appears
this
to
morning
be
too. The
a
last
sustainable
5
path
minutes
to our
was a
2%
rip.
objective.
Both ES and
Disinflation, while
NQ just
preserving
jumped
labor
hard,
market strength,
like
is only
20, 30
possible with
points.
anchored inflation expectations.
Yeah, I'm looking at just everything is ripping higher. Gold, silver. You still got anything going on silver right now?
I've got credit spreads on SI. I'm long SLV with ownership. Yeah, I mean, I'm liking silver a lot.
Guys on the Powell front, we'll keep an eye on it. We're going to keep looking for headlines and stuff. Powell got what he really seemingly wanted to say, said clearly by the market's reaction. Seems very dovish. Clearly stated that the upside risks to inflation. There was a pivot there, Chris, that was pretty monumental. He has been saying dual sides, both sides look evenly distributed. Today was
All
different.
about inflation. It was all about employment today.
Yeah, he said
Yeah.
upside risks to inflation are not as significant as upside risks to unemployment. What that tells the market is rate cuts are coming, and they're coming fast. And that the Fed, I put out this whole tweet yesterday, Chris, that the Fed only hates one thing more than inflation, and that's deflation. They do not like the recession concept because
Right.
the real value of money goes up a ton, and then their giant mountain of debt looks horrendous. So they
Right.
don't want the economy to slow. So we got confirmation from that, and market is loving that. But what is notably loving it more is gold and silver. Gold, silver, oil, commodities are actually outpacing the jump in indices. That being said, Russell, I'm feeling pretty good about the Russell. What about yourself?
Let me take a quick look at it. So RUT are the trades that I need today. I mean, it's ripping in a big way. I have shares of IWM at two. I own shares at $200. With I'm trying to think what I collected on my. It was a ratio spread. I think I took like part of that 182 by 2 and change, but I own shares at $200. We're 217. I'm going to try not to cover it. I'm going to try to let this run back to the highs. If the IWM gets to, we had the FOMC highs from July right around 227, 228. If we get back to that level, I may add in a covered call, but ideally, this is still like that really nice catch-up trade where if we get the IWM or the Russell at all-time highs, cool. Like I'll be taking a ton of profit up there. But this is also one thing I noticed today. This is MES, which is the micro E-mini futures for the S&P, and the NQs. I mean, the NQ was down below the weekly VWAP all night, and we just ripped above that during Powell this morning. But I have seen an interesting rotation where we clearly got closer to the all-time highs with the S&P than we did on the Nasdaq. Understand that yes, the S&P was down 9 and change, almost 10%, where the Nasdaq was down 15+%. The NQ was down over nearly 20%. So there's more of a comeback. But I do wonder if the market broadening. Do you know that RSP hit all-time highs versus the S&P? Yeah, RSP is at all-time highs. Yep,
that's great to hear.
So broadening out is a good sign. That also is helping the Russell, kind of showing that there is some flow going into small, medium, large cap, to the sense of it's just not Mag 7. I mean, I think I have a screenshot of this yesterday. This is yesterday's heat map. All Mag 7s were down. You know,
Yeah.
everything else looked okay. I wouldn't say this isn't bright green everywhere else, but it
Chris,
certainly was
it might
steady.
be back to the broadening trade for a minute
Yeah.
here, because you're talking about okay, you just got from the Fed chairman
hmm
an unbalanced risk now. Unbalanced risk favors heavily the more interest rate sensitive stuff.
Yep.
Because if inflation's not a threat, then what's the Fed going to do? They're going to cut rates. And if
Correct.
the Fed's going to cut rates, what does that favor? It favors a couple things that we just discussed prior to the meeting. I was talking about that favors the Russell, that
Mhm.
favors silver and gold, right? Things that are rate sensitive. TLT's probably having a good day today. Yeah, TLT's up 7.75 up there. So, stocks are gonna love it, broadly speaking. But if you get a little creative there and you have a little more allocation to things that are going to like rate cuts more, such as the Russell, such as small caps in general, those things are doing quite well today. You got the VIX down 6% today, so VIX continuing to suck the life out of volatility, it seems. And we've got Russell up near 2% today. The Asian markets also up today as well. It seems like you're getting a bit of a broad rally. I got to check the heat map for today as well. Just see, look at that, nice green. Semiconductors loving it, but the rest of tech about as green as the rest of them, it seems.
Yeah, and Nvidia. So next week we have Nvidia on the 28th with earnings, and we have Core PCE on Friday. But I do think this market is over the inflation threat. I mean, Powell's kind of reiterating it today. Well, obviously, Core PCE does matter, but if inflation's over and done with, now it's going to be employment news every Thursday with unemployment claims. We're going to have non-farm payroll that first week of September. I was surprised the new home sales were up as high as they were. We've had some pretty nasty home prints. I posted a video yesterday. Nick, let me get your thoughts on this.
Yeah.
Do you think? I know this chart looks nasty, but let me zoom out here for a second. Do you think it's possible that we just kind of cap this move? Let me go back a little bit further if I can. Something like this, maybe. Do you think it's possible that we have something like this where we just don't do enough to break the highs, but we don't necessarily do enough to break the lows, and we're going to deal with some indecision? Or do you think that this is enough where the pivot to employment and the Fed's going to be more aggressive? Do you think that's enough to get the market excited for new highs? I mean, my thought of, if we're going to an aggressive Fed and aggressive Fed cutting, why are they cutting aggressively? Because we're worried about slipping into a recession. We're worried about the labor market really taking us into a huge slowdown. So I don't know if that's a good thing.
No, I'm with you. And I think that, gold and silver telling us a little bit of story there, right? When
Yep.
gold is ripping 1%, yes, this makes straight up sense because, they're going to reduce the Fed funds rate. That's just always bullish for gold, right? Rate cuts is good for gold. I get that. But again, I was talking about this. I had to cut this thought process short because Powell was stepping up to the stage.
Mhm.
But gold is outperforming the S&P 500 this year. That is not a risk on signal, risk off signal, if you will.
Right.
Now, again, I'm not bearish on the market. I've got positioning all over, but my point with that is you can't ignore that forever. Gold going up 1% today, near all-time highs, outperforming the S&P 500 this year. There are reasons to be cautious. And here's my honest opinion to your question about as we get closer to these highs.
Mhm.
Here's my take on it. NVDA will decide whether or not we reject that or we break that. I think it really comes down to that because NVIDIA is such a behemoth in this market. It is such the story stock. And its earnings, it seems like it comes down to it every time, Chris. It's like earnings for NVIDIA. If they hit, the market rips. If they miss, and not the one thing, the catalyst there is they're probably going to beat their earnings. It would be terrifying if they don't beat their earnings.
Sure.
The question is, are they going to beat massively and raise guidance massively again? I don't know. How many times can you do that? That's the question.
Well, and I mean, the argument was going into last earnings season for NVIDIA is that it was kind of priced to perfection. So I mean, they still beat, but everyone was talking about, will they barely beat? And I mean, still 5.9 to 9%. But I mean, these were monster beats, like 12.3, 8.37.
On a ginormous
19.4,
company,
11.94. I mean, the percentages were way, way, way higher the last couple of prints. And the last one we did was little bit more of like a thinner margin of beating expectations. So I still think it's priced to perfection. Where if we do break, I mean, I wonder if it's a stall right in here on Nvidia. I could see earnings, pushing higher. I could see that being a fade as well. But again, would I short the stock? No, I would just like trade a bear call spread and see if I'm right. If I'm wrong, okay, fine, it's defined risk. But
Yeah.
if they miss, ugh, who knows? Like if
That's
they
not
miss,
fun.
it's
Not fun. Yeah.
it's gonna bring everything down in a big
Well,
way. So
that's the thing, Chris, is as we look at this, as we gear up for NVIDIA earnings, I really think that what the Fed just did is they made themselves pretty clearly not adversarial. Okay, now we have a tailwind. To be honest, as long as the economy's not crashing, we just got a nice tailwind confirmation from the Fed. Hey, we're going to basically cut rates. We're watching the employment data, inflation. We don't see risks. That's all super positive for the market, as long as the economic data from here doesn't start to sour. If you start seeing sour economic data, bad NVIDIA earnings, you got to be real careful, because then suddenly you're looking at markets all-time highs, S&P, you mentioned RSP, all-time highs. Keep an eye on the economic data. As long as, for me, here's where I'm actually positioned, is as long as that economic data doesn't sour, I stay long. But if something shows up, I'm keeping these stop losses pretty tight to get out of the way. If something, if NVIDIA earnings come in bad, that's a short-term catalyst in my view that could turn into, correction of 5-10% again.
it definitely can. So just the next few weeks out, I mean, we have just shy of a month before we have our FOMC meeting decision on the 18th of September. But it gets us to, we have NVIDIA earnings next week, Wednesday. We have core PCE on Friday to wrap up the month. We have non-farm the week after. Unemployment claims will be coming in every Thursday. And, I know that, like we said, maybe the Fed is over the inflation stuff. Maybe is it just concluded that inflation's fine? Like, we're not worried about core PCE anymore. We're not worried about CPI, PPI because the trend is lower. I think it still matters. I mean, if we have a CPI print at 3.1, 3.2, the Fed can say that, things are coming down. We're on our way to the target. But if we print higher, that's not going to be a good sign to actually see that print. And that's prior to the Fed meeting on the 18th. And then unemployment claims and non-farm. I think these will be the more kind of market sensitive ones. And this is going to be the first week of September will be the 6th. And then unemployment claims coming in the 29th and the 5th. And then we will have CPI, I believe, the following week in September. I think it's going to be the 10th and 11th will be the CPI, PPI, or it's Wednesday, Thursday, the 11th and 12th. But somewhere in that window, we're digesting all these things prior to the official Fed decision. Now, I still think it's interesting, Nick. If you look at the watch tool, the Fed watch tool, the market's looking at 100 basis points of cuts by the end of the year. And so
how's that going to happen? That's the question.
I don't know. I mean, right now it's 25, 25, and 50 as the higher probability for December. I just think that's, I mean, if the Fed's going to cut 50 basis points, why would they wait to December versus doing it now?
I keep going back and forth on this.
I don't know.
But I'm
thinking
thinking
any sense to me. Yeah.
Yeah. I'm like, maybe they should just do 50 up front. And just because 25 basis points, is it really going to seriously move the needle? No, maybe psychologically it gets people thinking, okay, Fed is serious. They're going to start cutting. I think most likely what will actually happen in September is 25 basis points, because we haven't seen any follow through since the big scare, the growth scare that happened. We haven't seen any crashing economic data to tell us.
Right.
We've had good unemployment claims since then. We've had some good PMI data. I don't see the catalyst for 50 just yet, but I don't know. The market's kind of telling you there that maybe there will be some continued slip in the economic data. But if there's one thing that's been challenging the last few years, Chris, it's been U.S. economic growth has been shocking for years now. And I just don't know where trying to call that end in sight is. Maybe some geniuses at the Fed know something. Well, they definitely are smarter than me, but maybe they see something that I don't. But right now it seems like the economic data continues to roll in pretty good. I mean, look at that Russell, by the way, Chris, 2.7 freaking % on the day. And that's after a nice rally it's been having. So, yeah, I mean, the thing is, the hedge, the question is, do you start looking for hedges if you start getting back to the highs? I think for me, we know where I sit on that. I keep some cash heavy, and then I am also, trailing stops, but we'll have to see. So a lot of people are asking about gold. Gold is ripping back to the highs. We're at 25.13. Chris, this entry, I might take a picture of this, print it out, and then like tattoo it to my forehead or something, because I wish I had more entries that looked like this. Yesterday I bought gold. It was a first attempt on buying gold, and it bounced pretty good here today.
Nice.
Question is, where does it follow through, and does it follow through for the right reasons?
Right. Yeah. I mean, following through for, risk off is not necessarily the right reasons. It's good for gold.
Right.
I mean, I think there's
Yeah.
a lot of cases where a lot of things right now are sizing up for good for gold. Good for gold, good for silver. I will take both of them because that's been a 3 to 5% diversification for me all year on each. And I mean, they're both looking pretty good. I mean, I wish I had a heavier position in gold.
Sure.
Let me check here. So my GLD is up around 8 grand. My SLV is up like 34, 35 grand. My futures trades, so GC up around 6 grand, and silver futures up around, I've got 3 of those. So that's 23, that's 34, about $5,500. I mean, I don't know. I rattled off a bunch of numbers there, but I've got some exposure. It's up a decent amount. I wish I was heavier, but I'm also not getting out of them. Like there's still room for that to run. And as we look at gold and it's still going higher, look at silver still going higher, all those could be very good for that's why I allocated what I did. It wasn't crazy heavy. And then meanwhile, I'm just trying to figure out what would be appropriate to trade, indexes and other things. I'm going to take a nice win today in RUT. Let me see if I've got to check on Palo Alto. We're back up now.
Take a play on that one.
I took an earnings play. It was up. So the problem was it wouldn't fill me. I mean, we're up here towards 368 to 374. We closed at 360. I was trying to get out of the trade for break even. I was trying to actually get like a 50 cent to $1 net credit. But right now it's at 351. My strike's at 360. So I'm out of the money. My put side is going to expire worthless. So I'll take a small loss on it today. I collected like 710 credit out of a $10 max risk. So I'm going to lose 290 today as it stays in the middle, but it's fine. I mean, that's fine. Russell, I'm in 4 contracts for Broken Wing Butterfly. That's $1.50. So I'll make some good profit there. I've had some good short-term trades this week on S&P and Qs. I mean, Russell is ripping. We're up. I mean, that's a crazy. We're almost up 3% today, dude. And the fact that I own the shares, I mean, this should be coming back in a big way. I hate to get in front of it with like covered calls immediately. So I might just wait, like I said, to hit this like 226 to 228, and I'll probably throw in like a 10 delta covered call at like 230 and change. If it gets called away and I own the shares at 200, gets called away at 230 plus. I mean, I know it's not the high at 244, but to me, if I'm generating like an extra $1.50 to $2 of credit, it might be good enough, and just let it get called away. So,
Chris, I think today's performance on the Russell also tells you something about its status of being a contrarian play on Wall Street, because it is not the crowd favorite on Wall Street. They hate the Russell. You listen to them talk about the Russell. They're, oh my gosh, these companies, they don't earn anything. They're the thought process for a long time, and I was on that train for a long time too, was Fed's not going to cut rates. They're not going to hurry to cut rates, and that's just going to keep the Russell down in the dumps. But at some point, we've talked about this trade for a long time. At some point or another, you're going to wake up one day and the Russell's going to be doing its thing, and it's going to be catching up to the other ones.
Yep.
That is how it goes over the very long term, not the short term, not tomorrow, not next week, but over the very long term. The Russell usually keeps up with the S&P 500. And here's, going back to 2022, or 2021, we're not even at the highs. The S&P 500 is at the highs, or just about. So the point here is that if we see a soft landing, the winner in that story is the Russell. That is the story, because it is so hated from all the people who have been so cautious about, recession, and to be clear, if we enter into a recession, it's not the winner, and it probably gets hit hard, but that is where the risk to reward there is. And I've been talking about that, Chris. I know you've been a big fan of the Russell for some time, talked about that recovery play. So, Russell should be interesting to see where it goes from here, but really big up day. And I love to see that, because, the other thing to the stock market rally is I was just getting so frustrated, Chris, with when we were talking about it for months on end, that there's like 10 stocks rallying and everything else is doing nothing. Yep. And it's like, that is so frustrating, because if you're not in those names, you're underperforming. I've underperformed the year, the S&P 500 this year, not by a huge margin, but by a little bit, because again, I haven't been full tilt, allocated or full port allocated to Nvidia this year. So I don't know. Russell may have that potential to play comeback from here, I think.
I mean, I hope it does, because I'm looking at my Russell positions here. I mean, I'm up about $9,600 on Russell with that potential. Like, I've got another probably $10,000 in profit with some of those debit spreads. Like, if we get to the highs. So here's what I have on the Russell. I do have some shares, and I want to let those rip. I have the 240 by 270 bull put spread, a 245 by 270 bull put spread. And those were out of the money. And all I really need price to do is to get towards those all-time highs, and those would be worth a lot of profit, because I went out to, I think I'm out there towards the end of the year or into Q1. Yeah, I did February expirations on those. So I'm going out to the end of the year into Q1 of next year to see if we get to all-time highs. So Russell could be a sneaky little like dark horse for me, where it does just, maybe it's 20, 25, $30,000, and it's a nice little sneaky trade to the upside. But now it's nice to see this. And I pulled this chart up here. This is NASDAQ in blue, SPX in pink or maroon, and then the Russell in purple. And this is what we're talking about. This type of outperformance, and underperformance, this does happen throughout history. We have this large cap versus small cap. We have tech in the NASDAQ versus small cap, that if this starts to go sideways, this might catch up. Now, what I don't think will happen, Nick, and we've said this before, I don't think that the NASDAQ necessarily goes down and the Russell goes up. I don't think that necessarily happens. I think the NASDAQ just kind of stays maybe where it is, but allowing this to catch up. So I do think we have to have a healthy broadening market for the S&P to stay stable, the NASDAQ to stay stable, and then the Russell can play catch up. But if we all just turn over, the Russell's not going to rip to all-time highs when the SPY, the S&P, the NASDAQ is down.
Yeah.
We're not going to drop 5 or 10%. The Russell's going to rip 20% to the highs.
Exactly. I think it probably is truly a catching up to the other ones. The other thing, the lesson here too, Chris, is I talked a little bit about kind of the Wall Street thing. Another one that pops to my head is that in 2022, it was like everybody you listen to on the television, on YouTube, all the brightest Wall Street people, you know what they were all buying? They're all buying energy, right? And then energy got crushed in 2023. And then in 2023, they said it's going to be an impending recession. And then tech rallied in 2023. So there's something here. There's a pattern here that I think is observable to the average trader, the average investor, is you don't necessarily want to be contrarian for the sake of being contrarian. That's not necessarily a good strategy, because sometimes the market's right. Or the participants in the market are pretty spot on. But there are times where if you do your research and you find opportunities, like I would argue you and I have been looking at the Russell last few months pretty aggressively, there is some really good risk to reward there. When you see the contrarians going, the contrarian opportunity to actually find value, because again, it's hard to really do quite well in the markets if you're just parked exactly where everybody else is.
Agree. Honestly, if I'm doing index plays, I'm probably going to favor the Russell. I think that if I did something in RUT or something in RTY, something in IWM, I'm going to take a look here. So I own shares of IWM, and I'm going to keep it that way. I'm doing some debit spreads in IWM. I'm looking at RUT and RTY with some out of the money. Like I've got some 111s and 112s on this, which just, again, fancy option stuff. But I like the fact that I'd said this in a couple of videos this week. We are making higher lows on the Russell. That's a good sign. And so I think as long as we stay there, I know there's probably going to be a lot of volatility, and it might do something like this, Nick, where it might be like highly volatile. I hope it's not like this, obviously. It'd be nice to see like, okay, we've had enough chop. It's making higher lows, and this thing's ready to kind of rip up here, pause, and then get another surge higher that takes out that July 31st high during FOMC. And then the nearest thing would be, we can hit all-time highs in the Russell. Because to me, like as a trader, that's my profit target. I'm good with this year's positioning on the Russell if we get to all-time highs, and then it's going to be moving stop losses and protecting profit. So my sights are set there. I'm just thinking maybe I can load up a little bit more with some of these kind of stops. And so let me see if I can look at something right now. And let me go to RUT. So this low is 1990. Let me see what this looks like on RUT. So RUT, look at 1990. So if I went out, let's say, I don't know, maybe 90 days or so. This is 98 days out to November 29th during the holidays. 1990 is right here. I mean, I could get $25 of credit, which is a decent chunk, but I'm going to have to hedge the bejesus out of this thing because obviously I don't want to just have naked put exposure. So
Sure.
let me see if I'm at 1990 at a 17 delta. That would be like the August 5th low. And then I can hedge this thing maybe at like the 1900 zone. Let me see what this looks like. So if I hedge at 1900, that's an 11 delta. Let me add in, let's do 2 contracts here at the 1900. Okay, so that's going to turn it into a debit, which I don't want. So I'd have to take this down a little bit lower. Let's get rid of this one. If I did like maybe a 5 delta, this would be like it almost be like a vol event. If I take this down to like 1700 and add in 2 contracts here. Okay, so I could still get some credit. I could still make 1185 credit. Let me make sure. So 1185 credit would give me $1,100 by November if we stay above 1990. I do have a hedge at 1700 if we have some type of vol event. I wouldn't take ownership of RUT. Requires 4350 buying power. That's a little pricey. I don't know. Let me think about this. Maybe broke wing butterflies. I'm trying to look at some creative option plays. Maybe I just stick with the old ratio spreads, man. Ratio spreads on IWM have served me pretty well. I got a sign on that first fall at 200, but yeah, I don't know, because that way if I take shares, I'd rather own IWM to fork over. You know, it's going to cost me 10 grand in margin as opposed to like RUT, which is you're on the hook for $20,000-$30,000.
Yeah, right. And I think I've the one thing I do love about IWM, it's probably the most money I've made trading options has just been doing my boring, sell cash secured puts on the Russell. I knew that I was willing to buy the Russell if I could get big sell-offs. I got assigned a couple times, and then I did not a couple times. So I sold puts a bunch of times, never got assigned. Finally got assigned, it ripped. I sold calls, got taken away. I was playing the Russell during this time because I just didn't see it going anywhere at that time. And that ended up being the right play. Of course, the real right play would have been to not sell covered calls and just to let it rip. But hindsight 2020, I made good money on that period of time, just trading the sideways motion. And now with the Russell, I'm pretty clearly, on the bullish side, but still willing to trail stops in this one. I want to kind of keep it somewhat loose on IWM. I would like to try and be there when it does make its move to the highs, whether that is, the remainder of 2024, maybe it's 2025. Maybe it's not so clear. Maybe we top out on the S&P and that drags the Russell and others down for a little while and we go sideways. But my lean on the indices side, I've been pretty predominantly focused on the Russell as my favorite play. The other one is the SMH trade, which has been a rock star. So we'll see if semiconductors can keep ripping here. Semiconductors are up against this kind of level of resistance, up 2.6%. So semi's doing well today off of this 1% gain on the NASDAQ, and still got to keep an eye on that gold move, man. That gold right back to the highs. I know a lot of traders are watching gold here today. A little bit of rejection at these levels, but again, Chris, I've been saying this, fighting the uptrend on gold this year. I've gotten so many comments on my YouTube channel this year of people just saying, Nick, where do I sell gold? Where am I shorting gold at? When's the, and it's just been every time my answer is the same to this. It's like shorting an uptrend on gold when they're going to cut rates. I just find that difficult. Now, if you think that they get overzealous about rate cuts and that the global economy's gonna be okay, and you see a big pop on gold, maybe you could justify looking for some kind of shorts, but you're going against the flow of traffic here. Gold's up more than the indices this year. I've said that a bunch of times, up like 22% on the year, which is, man, I don't know about you, Chris.
Crazy.
It doesn't feel like gold is up 23% this year to me. It feels like gold feels like 12.
It doesn't feel like 20% because it was such an aggressive rip right out of the gates. Like if you look at January, February this year, that first move we saw from that
Oh yeah.
consolidation,
Yep.
I mean, that was a 22% move in like 2 months. That's
Yep.
why it doesn't feel like it's up 20+% because it was just such an aggressive move right in Q1. I mean, we had this. I don't even know when this could have been January, February. Like when we were talking in March and this thing was on its way, like I was protecting profit pretty early. I had diagonal spreads and calendar spreads, and I was long on gold. And we hit profit targets and my measure moves within like 30 days. And I'm like, I guess I'm taking some profit here. So I think because it was so aggressive early on, that's why it just doesn't feel like it's doing much. I said this in a video yesterday. My idea of protecting profits and looking to get short gold and mostly just trapping profits would be if we have a capitulation move. We're not even
Mhm.
close to that. This has been such a steady, healthy, accumulating type
Just a
uptrend
grindy
that it's
uptrend.
just
It sprinted
yeah,
up and then it grinded up.
yeah.
And Chris, while you're talking about that, if we could just show my screen, Chandler or James, I just wanted to point out one thing. I'm bullish on gold. I'm bullish on stocks, but we need to at least acknowledge the seasonality of gold. Not something we
point.
usually talk about. We talk about SPX seasonality, but last 10 years, guys, look at this. This is crazy. First quarter, what were we just saying? First quarter, usually gold has a big rip. And then September, October, historically, not the sweet spot for gold. So just wanted to point out we are having a seasonally expected upward move on gold. August is kind of a usually slow month for stocks, and a little bit of volatility comes in. So yeah, something to think about as we go into September and October. That is a more seasonally rough time for gold, but also for stocks. I know we always come back to this one, but here is September is coming. So is it worth being a little, I guess, Chris, with the markets ripping, if you're somebody in the audience who's floating some big gains here, whether it be indices or gold, and we see seasonality, is it practical to look at least considering that it could reverse course in September?
Yeah, it certainly can. And there's room for gold to come back down. I mean, I could see gold coming down, 9 or 10%, and I'd still consider it a healthy bull trend. I mean, when I say 9 or 10%, I'm looking right here at this outer trend line. And I mean, I don't want to see it like crash lower, but I'd say if it just kind of,
Yeah.
turns over here, like stalls, gets a little bit higher, fakes out, stalls, and then comes back down, that's still a healthy correction. There's a buy and dip. We look at a bear trap scenario and then rip back up here. I mean, you could see this all day long, Nick. You could see price, come down here, test the low, break above, you buy it here, stop loss, and then you're talking about all-time highs again. And there's your asymmetry and upside that you as a trend follower, that could be a spot on trade for you.
Sure.
So yeah, I think if we have, and like I said earlier, I mean, if this were to all of a sudden just start ripping and getting like exponential, if this looks like lumber futures back in 2020, if this looks like cocoa futures this year in 2024, then yeah, I'll be trailing some stop losses on my GLD, and I'll just try to trap it when this thing gets nuts. Maybe it rips up here to 3K. I'll trap profit because usually when we have a parabolic move, it ends violently. There's rarely a parabolic pause and then just a healthy, slow correction. It's usually up and fall,
Right.
and
It's like,
they
look at that.
crash essentially.
I'll probably not forget for a long time, Chris, our conversation about NVIDIA a couple months back. I was so annoyed by NVIDIA going up every day. Talk about psychologically.
Yeah,
I talked about that earlier, how hindsight 2020, but I wish my whole account was just NVIDIA this year. Man, I'd feel like a hero. But
right.
if you didn't have NVIDIA, if you didn't have all the big super tech names this year, it's been hard to outperform. So when this was happening, I remember just being like, man, this is so annoying. It just goes up every day by a margin of 3%, 2%. You'd wake up, and if it was a weird day, if NVIDIA was up 1.5%, in fact, it felt like a pullback if NVIDIA was only up 0.25%, which makes no sense. It's like, that's how
pullbacks
fast
for flat days.
Yeah. And then look what happened. So everybody gets so bulled up, and then very quickly, in a matter of just a short, span there, you have a down 36% move on what is supposedly this indestructible stock. Now, again, if you took year to date, even with that huge dip, it looked like a monster. But My point is, when it comes to, these parabolic moves, you just got to be careful. Also, we just had a big spike down in the
I'm seeing
NASDAQ
that.
here.
Yep.
Not sure what that's
I'm
all about.
watching SPY and NASDAQ both. SPY is down 562 to 558. We just dropped $4 in the last. I'm on a 5-minute chart here. So here's my rip. I was looking at this morning. I was looking at buying a 565 put at opening bell because that was my big gamma level. But I'm like,
Yep.
it's Friday. I've made some profit already on SPY and Qs for 0 DTEs. I don't need to chase this thing. But I am wondering, again, it's Jackson Hole, which I know is not FOMC, but how many FOMC days do we see where the market, we gap higher, we push higher, and then we end up coming back to where we started, or we fill the gap on the day and nothing actually, there's no direction on the day. It's just a noisy, volatile day.
Sure.
Could be
Yeah.
the end result today. So, I think if we just stabilize here, that's cool. I obviously I don't want to see. If the market were to dump, it's like, what just happened? Did Powell say something silly? I know we have a bunch of other Fed speakers today, which I think is also kind of crazy. Like, look at how many, Goolsbee is on CNBC today. Interview conducted by CNBC, and then who was the other one? Harker. I don't know. Bloomberg TV. It's like, why do we have 12 Fed speakers that, hey, Powell speaking today, let's all jump on the horn and talk to?
Yeah, let's all just take turns. Yeah, you know what?
So,
Chris, I just thought this was kind of funny to share. My dad was telling me, as a just for fun, he was going to play around with some SQs today. He made a point that I just wanted to call out. I told Frank about this idea too. He just said, I'm just going to throw out for fun some like limit orders to buy SQs.
okay.
If the market just pops in that direction, he's like, I'll just throw out some fishing orders just for fun, just to see it. And look how well that actually ended up playing out here this morning. It just, to your point about usually Fed meetings look like this, that was his idea, was like, you throw out some buys and some sells, and just, if they get nailed, then you just walk away from it. But more of just a for fun observation, but seems to have been the the right call this morning.
Yeah, that's pretty nuts. And again, I'm assuming that's going to be short term. If he's in on that today, it's like those are trades you want to hold for a day,
fun, like
in and session. Yep. Let's see where we're at here. So we're giving up some gains. We've got a gap fill around 556. Let me look at the Qs really quickly. So I think that 565 is going to be not hit today. This went from 600 on my current net level for these gamma squeezes to 350. So we've been trimming that 565 level in the SPY, and then on the Qs, I've been staring at this level all week. And so yesterday I did hit it. I traded I had a 480 put and a 477 put, and those were Friday expirations. I was closing those out yesterday, and here we are dropping again. And I had mentioned 474 this morning, and we're filling up. It's too late to trade it now. Like, I'm not going to get in the trade. This thing has already dropped from almost 83 to 76. We've dropped $6 or $7. I'm not chasing this thing now to get a couple of bucks out of it. So that would have been the day. If I was like in the 0 DT environment, that would have been an awesome trade to be long a put, or looking at possibly MNQ or NQ futures and just getting short. So
I want to also
volatile.
draw just a call to action here on this this quick blip that we just saw to the downside. I'm not sure what was said. If somebody has the information on what was said, or was there something that just dropped that caused that quick reversal? One thing to mention here is that the Russell's still hanging in there way better than the other ones, and TLT just took the lead on the day, up 0.82%. So it seems like maybe, this is my off the cuff guess, that's more of a growth concern, because again, that would hurt the tech stuff the most, and it would help out the interest rate story. Because look at this, you got yields continuing to plummet lower. They have not bounced. It wasn't like we're not cutting it. It's more of a story of rate cuts are still happening, but maybe there was a bit more of a growth concern there that got mentioned. That's my guess.
The 2-year and the 10-year is also, the 2-year's down 2% today. The 10-year's down 1.37. So that also is narrowing that inverted yield curve. We're only about 12 basis points off. We were at 15.16 this week. Mostly we're at 20.25 last week. We did briefly get out of that inversion during that August 5th bottom, but this is getting closer and closer. And I do wonder too, you never know when the timing is, but it's like going from an inverted yield curve to then coming out of that has not ever looked good historically. So I don't know if these markets are going to try to keep this inverted yield curve like going for longer, because with the Fed maybe going on this aggressive path, maybe everything drops in yields and bonds go up. I don't know. I mean, I do you have any other bond exposure besides CLT? What else do you have? I'm
I
only
have
in
some,
TLT.
corporate bonds.
Okay.
In my really boring account, Chris, I've got things like USHY, which is a high yield corporate bond ETF. So I've got corporate bonds, TLT, and then in that account, I also have things got like SCHD. Kind of just the boring interest rate come down stability stuff.
Yep. Okay. Pretty textbook. I mean, corporate bonds are solid. I like SCHD. I like that one a lot, actually.
Yeah, I've also got O, which is the
That's realty.
Realty. Yep, for some
That's
dividend stuff.
monthly dividends. That's pretty
Yep,
solid.
exactly.
Yep, very nice. Very cool. Yeah, I mean, yeah. So I mean, look, yields are dropping, bonds are up. Markets have pulled back and actually closed lower than the open today. So we're kind of filling that gap from last night. The Russells, it's given back some. We were up nearly 3% at 2.8. It's dipped a little bit off those highs, but again, for this week, RET is making profit, RTY is making profit. I am going to look. So I did have a trade. Let me see if it's still crafted in here. I do have this trade here that I'm watching, Nick. I'll show you. It's basically it's a bear put spread on RUT. So I would do the 2020 by 1970. So if I put this on a chart here, 2020 by 1970, that'd be a bear trap. So let me go RUT.
Just below that level of support.
Yep. So it would be 2020 by 1970. So right in here would be a bear trap, and that's worth about $5,000 if price were to drop. And then my naked put would be 17,000, which is obviously we'd have to implode on the Russell for that to happen. But against that, I also have like I don't know what the strike was, maybe 1,200, something like that. Let me check that. I've got an 1,100 way out of the money, but I've doubled the contracts on this 1,100. That'd be like in the case of a vol event, but I could still make $4 a credit. The only issue is this is going to tie up $4,600 in buying power to make $400. That's less than 10% return on capital. I think I could probably, for capital efficiency's sake, I could probably just allocate to a trade like this week, the trade that I talked about all week, and I like to take this trade mechanically. I could probably just do 1, 2, 3 contracts in this trade every week on the SPX and have this thing generate. I might have to pay $1,500 to $1,700, but if I can make $300, $400, $500, that return on equity, return on capital is better than a Russell position that does have some potential volatility risk. If we did have like another sell-off and it was just a huge dump, I'd only have that like long put way out of the money, would have to just pay a huge amount, but I'd be exposed in the future side, which would not be good. So here's my takeaway from this year: having some futures exposure and watching that vol event we had through July 31st and August 1st and August 2nd, August 5th, that naked put futures exposure is horrific. Like there's no way you can really get out of it, because what ended up happening is it was blowing through stops when the market opened on Sunday night. Like I have 2x stop losses on those naked puts, and it was way beyond that. And like I said this, I mean, the limit stop loss was the reason I didn't lose my butt, because it would have been like a 10x loss, and I only lost like 2x because I waited for price to come back and stabilize. I took the 2x losses.
That helped. That was my big costliness was I was just trading Qs long, but the slippage and the where I got filled on market open was terrible. It really knocked me back. Fortunately, the big recovery, it actually kind of was a blessing in disguise, because I got stopped out of Qs, and then I had a bunch of cash, and I just thought about where I wanted to be allocated. I thought it was kind of a blip, so I went a little bit aggressive by allocating much more to like semis and Russell, and that ended up being the right call. So I bounced back nicely, but that was a rough Monday morning for me. Also, just wanted to mention one more thing, Chris. So SPX is up 0.6. You got Russell up 2.6. That's the type of conversation we just discussed about. If you want to see the Russell, let's say this is Russell, or let's say this is SPX, right? If you want Russell to catch up and it's here, you want to see days like this on repeat. You want to see Russell doing this and S&P doing this. And that's how you get that catch-up trade. This is a great staple. This is a great textbook example of how we could see Russell catch up. Is both are going up, but one's killing it, the other's
Yeah.
doing pretty well.
They all need each other. We can't have a down SPX, down NDX, and up RUT or Russell or IWM. Like it
Yeah.
won't happen. If we're going to see another 5 or 10% sell off on the S&P or the Nasdaq, Russell's going to get smoked right alongside of them. So
Yes.
yeah, you're right. Having that, like, I mean, think about it. 0.5% is always like a good day in the S&P, right? 0.5% to 1% in the Nasdaq is always good. If the Russell's up 1.5 to 2%, give that, let's say over a month of that type of outperformance by the Russell, that's the catch-up trade that we've been looking at. And again, maybe the best catch-up trade is I'm going to set a chart alarm. I've got it up here at all-time highs at 24.56. I'm going to set one right here at this July 31st high. That was right during FOMC. I'm going to set another one there, taking out FOMC July highs. Because if that's the case, I'm going to take a look at those debit spreads and see how they're doing, because I don't necessarily need price to get to all-time highs. Because if this happens fast enough, and I'm out to February, if this happens fast enough, my delta on a 240 call goes from maybe like a 15 delta to maybe like a 25 or 30 delta. So it is enough that I could see. I want to say I'm looking at like a $4 debit for a potential like $25 or $30 profit. So I mean the reward to risk is pretty solid. And I'll just keep an eye on it. So yeah, I hope we have a lot of these days.
Yeah, me too.
Yeah,
I'd love to see the rotation kind of take place. Chris, we're out of time here. We got our next show starting, so
okay.
You and I are getting booted off. But before we do that, we will be back. It's Friday, so we'll take a weekend. But then you guys know where we'll be on Monday morning. We'll be back on the A1 Trading Show each and every day, talking markets, doing what we love. So if you are new to the show, make sure to hit the thumbs up button and subscribe. And also, if you'd like to subscribe to Chris's channel, he's got his own content right here. He's got a Discord channel you can join. All sorts of good stuff. Do us a big favor. Make sure to go support Chris Pulver's YouTube channel. And Chris, have a good weekend, man. Take a break. You've earned it.
You as well, man, as always.
All right. See you, man.
All right, thanks, Dick. Bye.
All right. Next up, guys, we got Nick Phillips, who's going to be taking over the show. Last thing I'll say right before we do this quick transition to get Nick Phillips in here. Remember, guys, the Edge Finder sale, for those of you guys who tried out the Edge Finder, we're doing 35% off for people who took the trial. So if you tried out the Edge Finder this week and you enjoyed the tool, it is currently 35% off. If you'd like to take advantage of that discount, click the link that's just been dropped here in the live chat. Just click that link. You'll be connected to a member of our staff who can get you set up with a copy of the Edge Finder for that huge 35% off sale that we're doing. So take advantage, and you have the whole weekend to check it out. So don't miss the sale. We'll be right back after this quick break with Nick Phillips to take over the show. If you're looking to add fundamental analysis to your trading, then look no further than our software tool, the Edge Finder. The Edge Finder allows traders to approach the markets by simplifying fundamental analysis into simple scoring systems. We look at economic data, technical readings, as well as sentiment analysis like the commitment of traders data to help traders spot potential opportunities in the markets through the use of data. Our tools allow traders to find top setups each and every day from the top setups page. You can also browse the latest institutional money flow through the commitment of traders data report that we've generated to make it very easy to read. And on this report, you can see everything from the latest overall net positionings, as well as the week-to-week buys and sells from institutional money. The Edge Finder also has a retail positioning tool, which allows you to see what the crowd is thinking about your favorite charts, symbols, both currencies, commodities, and indices. You can also check out the latest seasonal trends month to month, week of the year, and much more to spot potential opportunities coming up in the future. The Edge Finder also makes economic data much more easy to read, like our GDP charts, our retail sales numbers, PMI data. We can also check out the jobs data, unemployment claims, and so much more. At the touch of a button, you can check out the latest reports from the economic data that moves the markets. Right now in the live stream chat, we'll be dropping a link where you can speak directly to a team member about getting yourself set up with a copy of the Edge Finder today, and we'll give you a nice live stream discount. Click that link and chat with a rep to find out what kind of discounts are going on right now. Now back to the stream.
Hello. Good morning. Welcome to the 11 o'clock segment of the A1 Trading Show. Just looking at some things this morning. I have actually not been trading this morning, which is a bit of a mistake on my end. For whatever reason, I was not tracking that Jerome Powell was going to be speaking this morning. Had I been, I would have been in front of the charts about 15 minutes ahead of this. It is what it is. We see that these comments that we got from Jerome Powell, let's see, right here, the time has come for policy to adjust, and market saw an immediate reaction to those comments. We do not seek or welcome further cooling in labor market conditions. That tells us, continued negative data from the labor side of things may throw a wrench in the Fed's plans. Let's see I think this may be the policy rate level gives ample room to respond to risk, including unwelcome further weakening in the labor market. My Powell, my confidence has grown that inflation is on a sustainable path back to 2%. The labor market is cooling, unmistakable. We're no longer overheated. Inflation has declined significantly. We're now much closer to the goal. The balance of risk to our mandates has changed. Upside risk to inflation have diminished. Downside risk to employment have increased. So this is all really dovish out of Powell. And I am slightly kicking myself for not being on top of it a little bit more this morning, because I would have loved to have been involved in this move. But regardless, let's take a look at the Doxy now, having these comments hit the market. It is Friday, so at this point in the day, I don't want to get involved in anything. The move has kind of happened. It's happened beyond where I would like to get involved. We are at a very pivotal price level here, though, nearing this 100 flat level. Even just hanging out here near the 101, we saw the 101 level has been support. Support got broken, but then reestablished right here. Support, and now we're back at this same level that we were seeing at the end of 2023, spring of 2023, and beginning of 2023. So will be interesting to see if we continue to break down below this level with the outlook of interest rate cuts being priced in really heavy to the market. Let's go check the Fed Watch tool real quick. So 100% pricing in for September, 100% pricing in cuts for November and December. So at this point in the game, we are getting cuts this year, theoretically, based on current money market expectations. Now let's see, September, we're still mostly priced in for one cut. And in a 25 basis point cut. And then in November, it looks like the markets are pricing in at least 50 basis points of cuts by November, depending on what we get in September. If we get the one cut in September of 25 basis points, that'll put us at 500 to 525. The next one would be 475 to 500. We're less than 50% priced in for that. So more than 50% priced in for at least 50 basis points in cuts in November. And we'll just assume we get the 50 basis points here, 450 to 475. What are we pricing in for December? An additional 25 to 50 basis points in December. Should be relatively interesting time in the market to see how the Doxy and stocks react to this. S&P, NASDAQ. NASDAQ's a little bit farther than Dow 13, S&P, but all reapproaching those all-time highs this morning. gold doing what gold does and just absolutely rallying. Interesting inflection point here. As we broke out of this channel at the end of last week, kind of hovered at the top of this area all week this week, sort of started to reject it yesterday, and now we've eaten back the entire bearish price action out of yesterday's market for gold. So definitely an interesting point in the markets. Gold is a tough one for me because I would like to see, if I'm going to get involved buying gold up higher, I would like to see it break beyond this just a little bit more, give us a little bit more price divergence from the top of this channel, and then come back to retest as support. Oh, gracious. Not surprising to see this price action with what Doxy's doing today, but definitely not something I want to get involved in until we have a little bit different price action happening at the top of this channel. Let's go tap into S&P 500 and see how we're doing here. Most recent highs and lows. I feel like equities have been on a sneaky run back up the last couple weeks here. Again, back at these highs, not somewhere I would want to be getting involved in for a longer term play, just because, again, buying high is not my motto. But I could see something on the 4 hour, I could see something like this happening if we're going to continue to get indications of rate cuts coming down, economic slowdown, as far as maybe not economic slowdown, but the ability for the Feds to shift policy to a more dovish stance theoretically should be good for stocks. In the meantime, on a technical basis, I could see a shoulder with a head with an we need price action to come down here to complete this right shoulder and give us that shoulder, head, shoulder, buy opportunity to the upside. So a good price level, good price area to start looking for buys on the S&P 500. For me, if I was looking to get involved in this on a long-term basis, it would be down in here somewhere in the 5430 to 5500 range, somewhere. Basically in here. Do I have a target box? I have a no buy zone. This is where I would be looking to get involved. Light green. So with the, for me personally, yeah, the fundamental bias being baked in of potential rate cuts coming down the road, barring any unforeseen major changes in the world, the geopolitical landscape, the market itself. I would say if everything continues in the direction that we're going right now, and the S&P pulls back into this area, this is where I would be looking to grab buys out of for the S&P. NASDAQ, very similar setup here on the NASDAQ, almost exactly the exact same thing I would be looking for Market on this side. Something in this range. Just to give us that head and shoulders price model with a pretty much ideal ideal price for entry. Let's see. All right, so we got buy zone here, buy zone there. I'll leave these up. I'll leave these pasted here, and then we can see over the coming weeks how things evolve, if it even comes back to this level. I'm not saying for sure like, oh, price is going to come back here, and when it comes back here, I'm definitely going to jump in. The way that I would be approaching this is I want to see price come down into this area. First, I need it to tap into the zone. Cool. Once it's here, I'm not just buying just because it's here. I would like to see, I would probably drop down to some lower time frames here, maybe the 1 hour, 2 hour. I'd like to see a bit of price action that gives me a good indication that the price is going to reject this. So whether that's a bunch of wicks in this area, or it's a double bottom scenario, another head and shoulder scenario. Worst case scenario, and something that would make me miss this trade, is if price comes down here, gives next to zero indication that it's headed back the other way, and then just absolutely rallies up. I mean, sometimes that happens. Price action from time to time. I'm trying to find a real good example of when this happened. Here's a decent example, I guess. It kind of did leave a little bit of breadcrumbs that it wasn't going to be able to continue up from here. But a kind of halfway decent example is price popped up into here and just immediately fell off. It's hard to catch that when you don't have as much breadcrumbs as something maybe like this scenario. Price fell down into this area, bounced, fell down again, gave a good solid rejection. Maybe on lower time frames, we had an opportunity to get in here. I mean, this is a pretty decent. If I got this kind of price action in my buy zone, I would get involved. Like if I had this marked up as a zone and price came in and gave me this solid double bottom, solid rejection candle here, I would like to, in an ideal world, hindsight capital 101, I'm saying, oh, I would have gotten involved here. And theoretically, that is true looking at this bit of price action. If given this exact same setup, and the ability to drop down on the lower time frames and see kind of how things are playing out. And in all honesty, I most likely wouldn't have gotten involved in this move until here, until the end of this candlestick here, the end of the 9:30 to 9:45 one on Monday. So we had the double bottom playing out at a larger time scale, and then you drop into a bigger time scale. And I want to make sure that I'm seeing good price action before getting involved. This a little bit of rejection. Theoretically, let's say a typical risk scenario for me might be like a 0.5% to 0.75%. I may go ahead and put 0.125% at risk when I'm getting this bit of rejection. 0.125% risk here, stops below these wicks. And then once I get this big momentum candle to the upside, this engulfing candle here, then I can add more. I'll throw maybe, I've got an 0.1% here. I'll throw on maybe a 0.5% risk at this level, and then let it ride until at least like a 1-to-1 or a 1 to a zone. It would probably be a zone is where my targets would be here. So let's say we get price coming back into our buy zone here. Some of my first targets are going to be these previous highs. So in an ideal world, we get our price action pattern in here somewhere. Price comes down. We'll just call it the head and shoulders. Boom. Get in on an engulfing candle somewhere in here. Stops below the wicks by a bit. Target 1 be about a 2. This is anticipating price action. Just kind of a rough idea, rough estimate. If we can get in at these levels, and this is where our stops are. Target 1 be about a 2 RR. Target 2 be about a 3 RR. And then beyond that, the way that I would manage this is simply, I would close out partial profits at 1 RR, go break even. And then at 2 RR, close out additional profits. All my stops are already at break even, so I'm good to go there. And just let runners run. And the way that I would let runners run is simply structure based. So every time we set a new low, a higher low, I'm moving my stops up. Stops moved up, stops moved up, stops moved up. And then eventually I'm going to get taken out, even if it continues to go in my direction later. At some point, it will take me out of my full position. That's how I would handle this. How I'm gonna be looking at Nasdaq moving forward. Personally, I'm probably not going to be taking any of these kinds of trades, just because if you guys have followed my segment here on the A1 Trading Show, you guys know I trade red folder events pretty much only. So these sort of outlooks, good potential trades, just not something I'm personally going to be getting involved in. But I'll save this. Let's see. We'll save this and check back in on this in about a week and see where we're at. I'll just send this in here into my group, and then we'll check that later. Okay. So that's my Nasdaq outlook. Let's go switch over to currencies real quick. Let me see how everything's reacting. For sure, everything went relatively risk on this morning, but let me double check. A little bit of mixed sentiment at this point in the day, but earlier this morning, it was definitely a risk on market. Oddly enough, Japanese yen was not getting with the program. Let's see. Do I think GBP USD will go higher? Let's check. GBP USD has been just absolutely killing it. I definitely see upside potential here. This is sort of, I don't have a real good mnemonic device for the way that I'm seeing this, but it's almost like in the inverted scenario, you don't try to catch a falling knife, right? So the idea here is the momentum is to the upside. It's past a major structural point right here at 1.315 to 1.317. Its next major structural point that I can identify is going to be at 1.34, and then 1.35 is obviously a major psychological level. So the 1.34 to 1.35 zone is the next major point of resistance that I'm seeing on the pound. But yeah, absolutely. I absolutely think this could go higher, especially with the dovish dollar stance. If you got a weak dollar right now, most currencies are having a green day. Most other currencies are having a green day. Off the back when it comes to US paired currencies, off the back of the US dollar weakness. So continued US dollar weakness, a pair like GBP USD. I'm looking at the British pound futures, but this is GBP USD just on the futures market. It's the exact same thing. If we pull up GBP USD, exact same chart. So yeah, I absolutely think this can go higher. I think there's the next area of challenge is going to be 334.01, which on GBP USD translates to how many pips? Let's see. Oh, Scheiße. I think it's maybe a little bit different numbering. Another 135 to 275 pips. So about, a 200 to 300 pip range from here. Absolutely. I totally think there's definitely more upside potential for the pound. I do think that 3,500, 1.35000, that target is a good target because you've got an area that it's tapped into once and twice, rejected from heavy, 3-4 times rejected from heavy, rejected heavy here too, but that's more like the 34, almost to 34. Let's see, where is this level? Yeah. So yeah, I'd say I can definitely see it going another 100 to 200 pips from this area. It's like the opposite of when prices falling out of the sky, and you don't necessarily want to be betting against that momentum without any real reason to. So yes, absolutely. Closed my GBP USD buys, been holding for 6 trading days. Oh, that's fantastic. Let's see. 1, 2, 3, 4, 5, 6. Yeah. That's a fantastic trade. Good job. Why am I mumbling? I'm sorry. Let's see. Talk about USD JPY. Most USD pairs, if it's USD and then the other currency, my bias for all USD pairs is downside. Obviously, for NZD USD, that's upside. GBP USD, that's going to be upside. Odd USD, that's going to be upside. Euro USD, upside. But USD CAD, USD Swiss, USD JPY, downside all day. Now, as of the last time I covered this on the A1 show, it's going to be tough because price almost came back into my target range. Now I don't know if I want it, if I would like to see it come back into here. I think for me personally, this would be an ideal area to start looking for selling opportunities. It's just a matter of, is it going to happen? I think it could. It's going to be tough though. However, yeah, I think an opportunity out of this 151 to 152 area would be my ideal selling point. Anything else? Let's see if we can come up with a secondary scenario. It's a little tough. We have an area of support here. There's kind of previous resistance for a little bit back in August of last year. we don't have a ton of really solid price action areas right here. This is kind of a previous resistance turned support, kind of. I could see moving into next week. Maybe the market's discounting a little bit of what Powell is saying. I'm at a bit of a. This is a tough spot for USD JPY for me because it did not quite pull back to where I would have wanted to sell it from. Now that we've had the Powell comments and whatever other comments are going to come out of the symposium this weekend, now I'm not quite confident that it will get there. And then vice versa, if it does get there, why? What's going to drive it there? These are some of the things that are going to make me a little hesitant too. So the secondary scenario for me on USD JPY, which might be a good opportunity. Let me jump out of this daily. So something that could work here would be like a pull back into, I mean, you're talking about waiting for days or weeks for that kind of opportunity. The positioning here is tough to navigate because I could see it from here. I could see it rejecting these areas, maybe giving us a double bottom, kind of a relief rally back into this area that I'm talking about, and then selling off. The other scenario would be a break below this, retest this area, and continue to sell. So yeah, my outlook on USD JPY is continued bearishness. It's just a matter of where do you get in? How do you take advantage of the potential downside move here? So I think it's got to be one of two things for me. At some point, we pull back into this area and sell it down out of here, or we break down below this area of support and we get in either at the break or the retest. That's a personal preference thing. So we break below this area, pull back in. So two different zones that I would be looking to get involved. Target 1 and target 2. Well, really, target 1. This is my ideal selling area, and then target 2. All right, USD JPY. What about pound pairs in general? Trying to scroll through my mental Rolodex about what is going on with the pound right now. So this is my strengths chart for all the currencies. This basically is just a relative strength meter for the pound against all the other major currencies: the dollar, the euro, the AUD, the New Zealand dollar, the CAD, the pound, and the Swiss franc. And as of the beginning of August, the pound has been on a kind of an upwards tear here. And I'm having a tough time right now remembering where we're at with the pound fundamentally. Let me go look at. If you guys don't know this tool, it's tradingeconomics.com/matrix. It's a decent little tool. I think the Edge Finder is actually much better. It's cleaner. This is a little difficult at times to read through. Let's see. Inflation 2.2, previous was 2, so that's gone up. Interest rates got cut. Unemployment's coming down slightly. GDP is contracting slightly. I guess kind of mixed there as well. So it looks like some mixed data out of the UK right now, with the inflation rate seeming to take the cake on what the markets are caring about. PMIs are up. So this is another scenario where it's sort of just like looking at it on a technical basis. The markets are obviously rallying behind the pound compared to all the other currencies. And I certainly don't want to try to sell against this upward move yet. However, we should pay attention to data coming out of the UK to look for opportunities to sell, because we have this big fall off leg here. This could be seen as a technical relief rally where we are pulling back to, we'll call it this leg, to this low, retracing about, as of right now, about 70% of this down leg. Let's say price comes back into this almost like the 80% of the move recovered, and then we get some economic data that shows significant softening in the pound market. This would be an ideal area for sells to start looking to sell the pound off. And then it's just a matter of pairing it against a stronger currency. The other potential scenario is that the pound just continues to rally beyond this 100% leg, and then it becomes a different story. But for me, I'm looking for opportunities to sell the pound. Maybe right in here, just above the 786 fib level, tapping into some of these previous areas of support. If that all kind of coincides with data that comes out of the UK that says, oh, actually, the pound is a lot weaker than the markets have been pricing in, cool, perfect time to get involved. That would be my outlook for the pound overall. Can I talk about the healthcare sector? Absolutely not. I not my forte. I don't know anything about the healthcare sector when it comes to the market. So I'm primarily a currencies focused trader with sort of I keep a tab on the US stock market, but for the most part I stay right here trading the major currencies. Yeah, no problem, Lauda. Hopefully I said that your name right. Let's see. All right, guys, I'm not seeing any more questions. I think I covered just about everything I wanted to cover. I'll give you guys a couple more minutes to drop in any questions that you have before I call it. You know what? All right, guys. Hopefully you all have a great rest of your day and a great weekend from all of us here at the A1 Trading Show. Safe trading, and we will see you next week.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.